Obviously, you're aware last night Scott Morrison delivered the federal budget. It has caused a lot of controversy, as a fair few surprises. I thought I'd walk you through today the two main themes of the budget that affect our clients and particularly yourself is the big changes to superannuation and also the changes to business taxation. So the first change to superannuation that is copped most of the headlines this morning is the change to the amount you can have in a tax-free pension part of your fund. Traditionally, up till last night, people could have many millions of dollars supporting a pension. The earnings on those assets in their super fund would be tax-free. Unfortunately, from last night, they announced from 1 July next year, the maximum amount you can start a pension or have in pension mode on that day is $1.6 million. So for those clients who've got a pension balance over that amount, we're required to move the excess out of the pension account back into a normal superannuation accumulation account, where the earnings on that amount will be 15%. So it has really been a retrospective change to the people or taxpayers in Australia with larger than average super balances, and the tax office or the government have said, well, that doesn't affect a lot of people. So, but unfortunately, a few of our clients are caught up in that. So we'll wait and see the detail, but in essence, that's a fairly big change for those people with pre-existing amounts in their superannuation retirement accounts. And we'll be in touch as we know more of the new rules. The next change relates to the amounts you can contribute into superannuation as non-concessional or after-tax contributions. Before last night, you could contribute $180,000 per year or $540,000 using a 3-year bring forward rule, where you can contribute for the current year and the next 2 years in advance. As of last night and effective from last night, you now have a lifetime cap of $500,000 that you can contribute into superannuation as a non-concessional contribution. Unfortunately, the change is somewhat retrospective because the $500,000 cap includes any contributions made since 1 July 07. So if you've been contributing as to the caps in the last few years, and you've contributed more than $500,000 since 2007, you're unable now to contribute any more non-concessional amounts into superannuation as of last night. So it's unfortunately a very surprising and a bit of a retrospective change to limit the amount clients can put into superannuation. A further retrospective change, in my view, is the change of the transition to retirement pensions. Many of you will be aware of those type of pensions. They're the pensions that we can put clients on before they actually retire. So normally around the age of 55, now it's 56, you can start a pension while still working, and the earnings on the assets supporting that pension in your super fund have historically been tax-free. As of last night and effective from 1 July 2017, the earnings on assets in a superannuation fund that are supporting a transition to retirement pension will no longer be tax-free. There's been no changes to the tax treatment of the pension payments coming out of the fund. It's just on the earnings on the assets supporting that pension. So we'll need to work with you in the coming year to work out whether it's still viable to continue your transition retirement pension after 1 July 17, when we know a bit more of the details. Continuing with the theme of limiting the amount that can now be contributed into super from 1 July 17, the concessional cap being the contribution, the amount you can contribute into super in a tax-deductible form will be reduced down to $25,000. And a few years ago it was 25, they increased it 30 and then to 35 for those over the age of 50. It's now going to go back in a year's time from 1 July 17 back to $25,000, applying to every person regardless of their age. A positive change out of the budget last night relating to superannuation is where someone has an account balance in super, that is the balance they've got in their own account of under $500,000, if they haven't contributed their $25,000 concessional cap that I referred to a moment ago, they can catch that up, and they can catch up going back at least 5 years. So if you have an example where someone has left the workforce to have a baby or whatever and hasn't contributed into super, when they come back to the workforce, they're able to, surely, obviously they need to be able to afford it, to contribute the amounts that they could have contributed but didn't in any of the previous 5 years. So that's a welcome, but I don't know how practical concession that we've been given, but again, we'll see that the devil, as always, will be in the detail. Again, continuing with the theme of a tax on superannuation, and this was not unexpected as it was sort of one of the leaks out of the budget, is those on high income, those people on high incomes, their contributions have been subject to a 30% tax rate, not 15%, which is the historical tax rate on contributions. That has, up until last night's budget, been cuts in at an income level of $300,000. In essence, from 1 July 2017, so in a year's time, that threshold will reduce to $250,000. So again, the same rules will apply in calculating your income to determine whether you meet that threshold. So there was rumours it would go to 180. It's now been put in at 250, but not until 1 July next year, which is, again, we thought it might have applied earlier. So that's a positive change in timing, but unfortunately more and more clients will be suffering a higher tax burden on their contributions. A couple of just very minor changes to superannuation which have always bugged us as practitioners is employed people could never claim a tax deduction for their own personal contributions into super. They had to always salary sacrifice them, and that was often a real difficult from a practical perspective. So basically employed people will be able to claim deductions for their own super from 1 July 2017 and not worry about whether they're in self-employed, or so if the employer can put in their 9.5% super guarantee, they're able to claim deductions for their own superannuation contributions when historically that has been denied to them. So that's a positive change. The other related change, which has often annoyed us, is after the age of 65, historically a person had to be gainfully employed, as was working sort of in a job 40 hours over 30 consecutive days is the test we've always used, and to contribute into super. That test has been removed, so you can contribute now all the way up to 75 or 74 without passing that, what we call the work test, which is doesn't apply to many clients, but we have a few where we have to continue to monitor the work test. Well, that will become a non-issue as a result of these changes. In relation to the income tax changes for that concern business, and particular small business, out of the budget last night, there's been a couple of interesting changes that we just thought we'd walk you through. Probably in a broader sense, the tax rates. The government has confirmed that from 1 July 2017, the budget repair levy, whatever you call it, 2% extra tax that lifted the top rate from 47 to 49 will be abolished. Now, interestingly, and it's important to remember this, the Labor Party wanted to continue, so only this morning I heard Chris Bowen saying that they'd keep the 49% rate moving forward. So they're trying to attack the government that this has been a real tax break for wealthy people, where it was only meant to be a temporary measure to fix the budget. So the top rate drops from next July from 49 to 47, which is a welcome change, and a minor tweak to the tax bands. The 32.5% tax band basically started at 80,000 from 1 July 2016, so the year we're in, that we're about to start in a month or two, that goes up to $87,000. So there's a minor change there, but I think that all the politics of it, they're focusing on that reduction from 49 to 47 from 1 July 17. One of the real positives of why this budget's getting a lot of good press for its effect on business is the changes to the small business concessions, the tax concessions that apply to small business. The biggest change is, up until last night, a small business was defined as having a turnover of $2 million, or aggregated turnover, but a turnover of $2 million. That's going to be increased to $10 million, which is a very welcome change, and it applies from 1 July coming up in the next couple of months. So in essence, from 1 July 2016, a client with a turnover under $10 million will be regarded as what we call an SBE, or a small business entity, and will be eligible to claim quite a number of concessions that simplify their affairs, simplified trading stock, simplified GST reporting, I think there was simplified pay-as-you-go instalments. But importantly, for the next year till 1 July 17, the $20,000 instant asset write-off will be available to those clients who've got a turnover under 10 million. And so that brings in a lot of different clients who were excluded from that really generous concession announced last year, now can claim up to 30 June 17 a $20,000 instant asset write-off, and that's one of the things getting a lot of press at the moment. A link to this small business entity concept is if you're a company that is a small business entity, there was a plan for the tax rate to drop to 28.5% announced in the budget last year. They announced last night that from 1 July 16 that tax rate will drop to 27.5%. And there's a bunch of plans to lower the tax rate to 25 over the next 10 years and expand that to all companies really. But for clients in the next year or two, if you are trading through a company, you're eligible for the 27.5% tax bracket in the next financial year from 1 July 2016. But it's just important to remember that generally most small businesses don't trade through companies. I mean, some do of course, but they're mainly through discretionary trusts, which is common and more popular for a variety of reasons. So don't be lulled into a false sense of security that this tax break might be available to you, because you have to actually trade through a company, and so it's just something you need to be mindful of. It appears really good on the surface, but it may involve a discussion about your ongoing structure, whether you want to access this 27.5% tax rate down the track. But let's see the detail when that's ultimately announced. Probably more for the accountants, but it's something we would have heard us talk to you about over the years, is Division 7A and company loans and all the work and all the worries we put in to make certain you're compliant. The government announced last night that they're going to introduce some concessions to help the compliance burden and to make inadvertent mistakes not so horrible in a tax outcome. So some of the things that we haven't seen any details, but I'm aware of the report the government's got, that they're talking about maybe using a 10-year term, not a 7-year term. So we'll be in touch with you as these things come out, but they're more likely to be very positive and maybe take the worry of Division 7A, make it a little less in the future. And the last change, and I left it to last because it sounds great, but it's actually not that fantastic, is the tax discount for non-incorporated businesses. So basically what it means is if you're not incorporated, so you're not a company, so you're not getting that tax rate reduction, so this is through a trust or a partnership or a sole trader. If your turnover has been below $2 million, you could claim a small discount on your tax. I think it was 5%, capped to only $1,000, and that's why I'm leaving it to last. They've lifted that to now $5 million from 1 July 16, and the cap is still $1,000, but the discount is now 8%. So basically what is going to happen is you get a discount of 8% of your tax bill capped to $1,000. So it's just a weird way of giving you a $1,000 tax break if you're not in a company, to compensate for the company tax rate drop that companies are getting under this budget. So it is only $1,000, so I don't think we should get too excited, but it's something you need to be mindful that it applies now for businesses with a turnover of 5, not 2 million. I know I've covered a lot here today, but there was a lot in the budget. Some clients are going to be affected by many of the changes, some only by a few. Hopefully some are not affected at all. If you're concerned about any of the changes or want to know a little bit more detail, just give our office a call and talk to the person who you normally deal with, and they'll walk you through the changes and how they impact you and whether there's anything we can do to plan for them, because obviously most of these changes are not coming in for a year or two, so there might be some planning strategies, and we've started with a couple of clients on maybe some things we can do around their superannuation. So reach out to us and we can walk you through the changes.